thank you for joining me today. My name is Wesley Boudreau, one of the financial advisors here at the Retirement Group. Today I'm going to spend a couple moments with you going over some different questions we've been getting recently from ExxonMobil employees, and especially those transitioning into retirement and grappling with the changes in interest rates and how it's affecting their pension lump sum calculations. Before I get started, I'll go over the Retirement Group, but I do want to remind everybody that even though we've worked extensively with ExxonMobil employees, we are not employed by ExxonMobil, nor are we endorsed by ExxonMobil. For those of you who do not remember who the Retirement Group is, we've been working for about 30 years. We're an independent financial advisory firm that has been working with corporate employees, helping them transition into retirement. We work with a select number of companies, Exxon obviously being one of them. The reason we do that is it allows our advisors across America to get a deeper understanding of your specific benefits plans and help you through that transition, whether it not just be the pension plan, but also the 401k, healthcare retiree benefits, life insurance, all that information. If you have questions on it, feel free to give us a call. We'll be happy to dig into that with you. Now, as I mentioned, we do have offices throughout the country, so rest assured if you want to sit down with somebody face-to-face, that can still be accommodated. But obviously, we can talk with you on the phone. We can set up web meetings, exchange emails, fax, whatever's going to be easier for you. And ultimately, we'll talk about it probably at the end of this webinar. But if there's anything you take us up on, it's our complimentary cash flow analysis. And I know a lot of you have done this. If it's been over a year, even over 6 months, there's been such significant changes in both the market and interest rates, how it affects your pension. It might be beneficial to give us a call and run an update on that as well. If you've never done one, then it's really a good idea to give us a call, because this is a way to essentially put down on paper and show you what your retirement picture looks like, not just now, but in 10, 20, 30 years down the road as well. And we're able to look at various scenarios, whether you want to look at retiring this year versus next year versus 3 years from now. You want to spend more, spend less. There's a lot of different variables we can plug in there for you to essentially give you the financial answers and show you if you are on the right path to retirement. So with that being said, let me get into a lot of the questions we've been getting more recently from employees of ExxonMobil. And the first one here, the first one we have is, this unfortunately, a lot of people are going through this process right now. I've talked to a few already, both employees and managers having to grapple with the stress of going through this. But I am in a PIP. Should I leave as soon as possible or wait a few months? This is really going to be kind of come down to what your feeling is about your success level of getting out of PIP, if you can find another position. So you need to kind of have a heart to heart. I don't know if your manager's not supposed to give you information, but if you're finding other options out there and you think there's a chance that you could get there, then obviously if your goal was to work longer, then go ahead and stay on that. Otherwise, if you're close to retirement and you were thinking about pulling the trigger to retire soon, this could be an opportunity for you to do it now, get a little bit of pay for not working, but also capture the lower interest rates for the lump sum calculation if that's the way you were going. But to be honest with you, this is a question we get, but it's something we need to kind of dig into each person one-on-one, find out what they're trying to achieve, find out where they are in their career. Because I've talked with guys on the PIP that are in their 30s and others that are in their 60s and they're ready to retire. So everybody's a little bit different. So there's really no real quick answer for that. If you are in this situation, unfortunately, give us a call. We can run those numbers to show you hypothetically if you were cut now, could you survive? If you need to go back to work, for how many years, what type of pay you need to look for. So we can go through that cash flow analysis and give you those choices and those options on there. And another one, let's say, okay, this is a longer one. I'm aware of rates, but I do not want to retire until 2023 or 2025 when my kids get out of college and I'm 63 years old. If I were to get a new job outside of ExxonMobil, I would be making 30% less than what I make currently. Have you looked at the pay versus the lump sum difference to see what's best? So this goes back again to that cash flow analysis I talked about. Absolutely, but there's not a blanket, one-size-fits-all plan. So this is kind of like that PIP question. It's going to be specific to your situation. So when we run those cash flow analysis, sometimes it could be as simple as somebody saying, hey, I'm retiring at the end of the year. I'm going to take the lump sum. Can you let me know if I have enough money to survive? Or it could be, I'm retiring at the end of the year. I don't know if I want to take the lump sum or the annuity or a combination approach, or if I want to work another year. That's when we run multiple scenarios to show you. That's where this kind of question comes more into play, where we can run the scenario of looking at, okay, let's update the interest rates, let's forward project the lump sum, show you that drop in there. Does it make sense to continue working to your original goal? Could you retire now if you want to maximize the lump sum options? Or could you retire now and go work somewhere else and make less money, but maybe Maybe it's a job that's less hours or more enjoyable. It just depends. So again, a long question. The answer is yes, we do this all the time. There's not a one quick answer for everybody, but if you want to see those numbers, in this situation, it could be running 3 or 4 different financial plans to see what's the best fit for you. And our goal there is to give you the ammunition, give you the financial backing data, and it's up to you and your family to make that emotional decision if you're ready. Because a lot of times we work with individuals that could have retired 2, 3, 4, 5 years ago, but they enjoy their job, and that's just what they do. That's how they identify themselves. So everybody's going to be unique and different. So again, this is really just going back to that cash flow analysis, and give us a call to run a detailed one. So another question, do I have to take my lump sum pension right after retirement? Can I wait to minimize age penalties? What are the risks? Okay, so question 3 has 3 questions in there. As far as waiting to take the lump sum, no, you do not have to take the lump sum or commit your benefits immediately after retirement. This is something we do with a lot of employees back during the pandemic when interest rates were actually going the opposite direction, going down. Because as interest rates go down, your lump sum is going to come up. So even if there were no age penalties to worry about, if somebody were retiring and we knew interest rates were going down the next quarter, we're going to tell them to wait a little bit to commence their benefits. In some cases, it made them an extra $10,000, $20,000, $30,000, $40,000. Now we're on the tail end of that, where interest rates have been coming up drastically, where if you wait, you're seeing your lump sum shrink, everything else held equal. Now the second question on here is there's age penalties in there. So that's going to depend upon what your actual age is. For generally speaking, to be a retiree at ExxonMobil, you need to wait till age 55 and have 15 years of service. At that point, you can actually take your pension. You're not going to get 100% of it, though. At age 55, you'd be only getting 75% because there's a 5% per year reduction. The 100% is going to be at age 60 for a retiree. So in this case, let's assume that somebody retired at 59 years old, and we knew the interest rates weren't going to change. They were flat for the next year, and they decided to wait a year, then they would get a 5% bump in their pension. They'd get up to that 100% level. So that's what this question is asking about. So really, it goes back to running that cash flow analysis, find out where you are, and then kind of juggling the ups and downs of the age penalties. Because again, even though you could defer your benefit and lose that 5% reduction, if interest rates are going out, it could very easily wipe that out and then some. Then you also got to factor in the opportunity cost of whether you were to invest that or not, or generate interest off of it. So all that goes into a calculation that we can run for you and find out that break even. And then what are the risks? I think I kind of went over that. The risks are if interest rates are changing, going up, it could actually, you could be sitting there on the sideline trying to get out of the age penalties, but you could be losing 10% on the flip side, and for a net negative 5% return. So again, give us a call. We can go through your specific situation, see what your potential age penalties are. Now again, if the question was on the lump sum, if you're thinking about the annuity, then that's a different scenario because the interest rates are not going to affect that annuity. So you could still see that annuity grow, and especially if you don't need that money, if you're working or doing something else, that's a great option to look at on the deferral side of it. So question 4, are you suggesting I should assume a higher rate on the ExxonMobil Benefits Center to see what my lump sum would be next quarter? Will they compare the 2 quarters? Absolutely. So the benefit of that, if you don't have a quadro on there, you can do the quick calculation through the Benefits Center. Definitely go on there and run different scenarios. I would run the one that you're originally thinking about retiring, and if you want to run one sooner to see the interest rates. Now, unfortunately, if you're questioning the lump sum, we've gone through the first 3 quarters. We've seen some massive jumps in the interest rates, and we're a little bit behind right now in the case that if you wanted the 3rd quarter interest rates, you would have needed to retire. If you were not grandfathered, you would have needed to retire August 31st in order to have a benefit commencement date of September 1st to get that 3rd quarter. So that's just past us. So now we're looking at, if you haven't done so already, retirements in the 4th quarter. Good news there is, we're not going to know those rates until, we know the 4th quarter rates. We know that from 3rd quarter to 4th quarter jumped quite a bit, about 1.17 points in the 2nd segment. What I was going to say is we won't know the 1st quarter rates until we get August and September behind us. And once we get those segment rates out, we'll know what that is. The good news is, so far from June to July, there was a slight drop. So hopefully maybe they're leveling off at this point, so we can kind of see that and look at those. If you do want to run updates on your interest rates, you can plug that in there and show that. That's what we've been doing with individuals for the last year, kind of showing them how these rates are moving, how it's affecting. But like I said, we're kind of past on some of those big rate movements, hopefully, and hopefully it kind of levels off from here. But no, ExxonMobil will not compare these for you. They will not put in the updated rates. They'll only put in the rates that are known. So give us a call. We can give you the updated rates, and you can see what that is for the next quarter and project that out as well if you want to see how that can affect your pension in the future when it comes to the lump sum. Question 5. I'm retiring this year and taking the ExxonMobil annuity. I was told by a coworker that I could potentially get a bigger annuity if I take the lump sum and buy a third-party annuity. Is that correct? Again, it's going to go back to a case-by-case situation. It's all going to depend. Generally speaking, right now, because the interest rates are going up, it may not be the case as what it was maybe a year ago when interest rates were lower and the lump sums were pretty high. Because what's going to happen is there's a break even there. So let's assume, let's assume that you had $1 million lump sum for simple math, and you had let's say a $4,000 a month annuity. What you would do is you would actually say, okay, do I want this $4,000 a month annuity for the rest of my life covered by ExxonMobil, or do I want that $1 million lump sum that I can do what I want with it, whether it be spend it all, obviously we don't recommend that, but usually roll that over to an IRA, manage it yourself, or work with a firm like the retirement group, or if you do want guarantees, you can look at an annuity on your own, and that way you're going directly through an insurance company and taking Exxon out of the loop, and that way you've also got more control of the assets, as well as if unfortunately something happened to you and you passed away earlier, your beneficiaries will still get the remainder of those assets, unlike some of the options within the Exxon pension plan. So that $1 million, it might, when you run the calculation, you might be able to get $4,000 exactly, just the same as Exxon, which would be great because you still get that flexibility of access to the money and beneficiary changes. Or it might be that it's only $3,800, and you might say, well, that might be worth that $200 difference in order for me to have control of the money if I need it. Or it might come out better. So it all depends upon what annuity providers are giving you right now. Interest rates have come up, so they're getting more attractive. It also is going to depend upon your age, longevity, all those different things. Whether you want cost of living adjustments, that's another unique feature you can have on annuities. But I will be honest with you, just because somebody's telling you that an outside annuity is better, that does not mean that's the case. As fiduciaries, our role is to dig into the details and find out what the best option is for you. So if you're coming to us and saying, hey, I want to compare an annuity versus the pension, we can run that for you. But likely we're going to look at about 100 different options, drill down on that, and whittle it down to maybe 2 or 3 and go over those with you, because there's not a one-size-fits-all. So be very careful if you go and talk to any insurance agent that's telling you about an annuity. A lot of times they have 1 or 2 different products they try and kind of put everybody into. So the answer to that, again, just like everything else, is it's a case-by-case scenario. Give us a call, we can run the numbers, because again, there's so many different nuances to this and different ways you can structure an annuity. But the simple answer of it is, a year ago, it probably was the case. Right now, because interest rates have come up, it might still be the case, but it may not be as comparable. But definitely give us a call, and we can run the numbers to show you those options side by side. The other benefit might be that maybe you want to take the lump sum and maybe only use 80% of it or 70% of it to generate an annuity to cover your life or you and your spouse's life, as well as provide for your beneficiaries, and the rest you can continue to invest in the IRA. So again, a case-by-case situation, just give us a call, and we can go through that in detail with you and run some quotes for you if you want to see. All right, so there's 5 questions. I know we've gone through a couple here, but obviously, our advice is to run that cash flow analysis. I think you heard me literate through there a couple times and answer questions with that. But that really is the best way for us to get an idea of what you're doing and what you're trying to achieve, and also give you better information on what's going on and how these different changes could affect you. And then obviously, we'd like you to schedule a meeting with us so we can go through that, and that way we can get those answers for you. But like I mentioned, that cash flow analysis, right now about 3/4 of Americans over 50 don't even have a written plan or any type of financial plan. It's not that daunting. If you could spend about 10 minutes with us, we'll gather some quick information, or we can email you out the questions we would need to get answered. Give us about a week. We'll put that report together for you, get it out to you, and spend some time reviewing it with you and running through if that makes sense for where you are now, or if there's any updates or changes you want to look at it. And that in turn can lead to answering a lot of the questions that we just talked about today, and a lot of the personal questions you may have about your own situation and how to make the right decision going forward. So with that, like I said, I want to wrap it up. If you have any questions, it's best to give us a call at 1-800-900-5867. We'll be more than happy to help you out with that and get you in touch with an advisor who knows the ExxonMobil plans. You could also reach us at info@theretirementgroup.com. And if you're tech savvy, have your cell phone out, you can go ahead and hold it up to one of these QR codes. One will get you into our LinkedIn page specifically for ExxonMobil employees, so you can stay on top of webinars we have, different changes to the ExxonMobil plans. We'll keep you updated on the interest rates, especially if you're looking at the lump sum and how that's affecting things. And then also, if you'd like to schedule an appointment with myself or one of our other ExxonMobil focused advisors, you can get into our calendars there. And if you need to talk with us sooner, again, give us a call, because sometimes those calendars show booked up a week out, but we can definitely accommodate you sooner if you give us a call and have any question you want to dig into. But with that, I want to wrap it up, and I want to thank everybody for spending some time with us. Again, I do want to reiterate that we've been working extensively with ExxonMobil employees, and we've retired a lot of employees. However, we are not employed by, nor are we endorsed by ExxonMobil. But again, any questions you have, just simply give us a call, and we'll be happy to dig into those. Again, it's 1-800-900-5867. Thank you very much. I hope everybody has a great day.